With concern growing of another global downturn, short sellers have their eye on vulnerable stocks. In the last few months, hedge fund managers have been active on the New York Stock Exchange targeting Chinese companies. It's a move which is fueling speculation that China may not be able to sustain its breakneck pace of growth for much longer. Michael Troy reports.
A symbol of China's economic miracle literally came off the rails last month, with a high-speed train crash claiming 43 lives. Now the first sign of a much bigger derailment, with short sellers betting China's economy will take a turn for the worse.
It is a big risk, but I think if you do the fundamental analysis of the numbers, there is no doubt that there are asset bubbles popping up everywhere in China, not just on equities, but on other assets such as property.
John Lee from the Centre for Independent Studies has noted some international hedge fund managers are short-selling stocks associated with China, because China is a very fixed investment-driven economy, with the government throwing too much money into building too many things that too few people need.
The fundamentals tell you that the asset price rises in China, both in equity and in property, have nothing to do with profits, they have nothing to do with demand, they have nothing to do with return on investment. Now, when you have a scenario like that, and money is being invested more for political reasons and speculative reasons rather than economic reasons, when sentiment changes, and sentiment will change, the effects are very unpredictable.
His view appears to have been backed up in the International Monetary Fund's annual review of China's economy. The IMF report said inflation, real estate bubbles and weak monetary controls pose significant risks to financial and macroeconomic stability. The leader of Norton Rose's China business, Ian McCubbin, however, believes the Chinese economy will continue to grow strongly for some time.
The Chinese have proven themselves to be very competent fiscal and monetary managers. I think they've generally pulled all the right levers at the right time, and the economy, I think, has gone through a transition period, and certainly through the global financial crisis, very effectively.
Short selling is all about timing and being ahead of a downturn. Last year, famous US hedge fund manager Jim Chanos claimed China was a bubble 1,000 times bigger than the Dubai financial crash. Chanos short-sold US giant Enron before its crash and waged a successful short-selling campaign against the Macquarie Bank during the GFC. Now he's short-selling all metals and, in particular, the bulks, iron ore and coal, all commodities on the rise courtesy of the China boom.
There's been some big, very outspoken and, in historical terms, very right commentators saying that if people could get their hands on Chinese stocks in some sort of size, especially in America, they'd be looking to short them if they could get the borrowing. The fact is that China is one big bubble. I don't personally believe that's going to be the case. I see, we are seeing huge amounts of development coming through.
The short sellers are sometimes referred to as the vultures of the market. If they do swoop on Chinese stocks, Australia's resources sector will be caught up in the feeding frenzy.
I do sense a bit of a head in the sand approach in Australia. I think our companies, particularly our commodity companies, have invested so much in the continued rise of China, largely in terms of increasing mining capacity for the future, that we don't really want to listen to bad news.
There are always going to be those who are going to look for signs of a slowdown or a more serious obstacle in China's development story. But I think that there are constant challenges for the Chinese government, and I think there's nothing in particular at the moment that might be necessarily triggering that short selling.
I think the Chinese do have their economy under control. I think they've got a huge amount of FX reserves which they can bring back at any time, which they can use to stimulate their economy if they need to do that.
China's high-speed trains have now been slowed due to safety concerns. But despite the risk, China's economy looks set to power on.